Michael, we've got hopes that the vaccine progress could be coming along. We've got Jay Powell stuck at zero interest rates and buying corporate bonds. We've got data beating expectations at the best rate ever, according to Citi Economic Surprise, and Wall Street chasing retail. So how does this not add up to bullish right now?
It absolutely adds up to bullish. It's a market that's literally and figuratively on steroids, and you just hit the nail on the head. From a health policy perspective, from an economic perspective, and then certainly from a fiscal and monetary policy perspective, all things are kind of steady and kind of ready to go. On the steroid front, dexamethasone is shown to reduce the fatality rates. Retail sales, Ollie, we're now shifting from data that was the worst ever to the data that's the best ever. This is the best ever number since we've been keeping retail sales since the early 90s. And then certainly yesterday and overnight, the commitment from both the Trump administration and the broader U.S. government through infrastructure potential, as well as the Fed, giving us more details on their corporate buying program. And markets are rip-roaring this morning.
Michael, when you have the rate of change, these data points that are the best ever, we're talking beat rates and rate of change rates, right? For the most part, still some of our nominal figures are troublesome, not in housing, which has come back in a V shape. But what about overall activity? Will that catch up to us, or should we just assume that if we continue at this rate, we'll make everything back that we lost?
Well, I do think you make an important point. And certainly coming off of very low levels, it will take some time to get back to where we were at the end of 2019 pre-pandemic. It's going to take a while, possibly anywhere from a couple of years, and we've seen estimates all the way out for 10 years. So definitely an important point. But in terms of markets and what investors are focused on, it's the fact that as the economy reopens, this data is getting better. And most of the severe pain was felt in March and April, and we are moving beyond that. And markets are looking forward and not backward.
What are the risks? I know that we're talking the steroid that is potentially helping severely ill patients from COVID-19, but there's also, some would argue, the steroid of zero rates and money that just keeps coming from the monetary side. Are there side effects to that steroid?
There certainly are side effects, and one of them could be this. We all continue to scratch our heads in terms of this incredible market rally that's taken hold here in the last 50 to 60 days. And I think one of the most natural explanations is, in fact, this liquidity provided by the Federal Reserve. And essentially one of the kind of potential risks for very low rates and all the stimulus is kind of that euphoric, that bubble-oriented kind of move. Now, I'm not saying this is one, but it's certainly a risk from that standpoint, that all this policy is just largely inflating financial assets while the kind of mainstream economy and the labor market continue to suffer. It is a risk to keep an eye on. Low rates certainly kind of penalize your more traditional savers. Right, you need to extend out on risk. Investing in the CDs or your kind of traditional bank accounts just isn't going to do it for you, and it certainly hurts your banking system. And financials certainly have struggled this year broadly as part of the fact of low rates, and they're an important mechanism to keep the economy going. So low rates may be a stimulus for now, but we really do need to see an economic recovery take hold in order to move forward.
What will be the best way to measure the strength of a recovery and its ability to offset some of those negative factors from zero rate policy? Is it employment? Is it in a narrowing of the wealth gap? I mean, what are the big picture things that investors should be looking at that would be a healthy sign that our recovery is sustainable and not just a pump?
For the U.S., I think the key continues to be the labor market. As we know, about 2/3 of the economy, maybe even a little higher, is driven by the U.S. consumer. And in order for them to continue to drive the economy higher and indicate a recovery, you need to see an improvement in the labor market. So initial jobless claims, the employment data, wages, those types of things need to improve. given the fact that the U.S. consumer makes up is the singular growth engine, really, of the U.S. economy. So that's going to be key. Also keeping an eye on how that fuels into corporate profitability. So certainly corporate profits are going to be down significantly in the second quarter, but if the consumer can come back online through an improvement in the labor market, we should see a rebound in profits. I think those two things are going to be key.
Yeah, I like that point, Michael, the details on what we should be assessing. There's a lot of comments I get from guests and folks who write in that say this is all just the Fed waving its magic wand and we're in for big trouble. In the meantime, though, it's just the old situation of not fighting the Fed or just not fighting the trend, because there's also now Wall Street money that's been parked in cash, it's been parked in bonds, and we saw from Bank of America's fund manager survey this morning, some of that's starting to turn. Any thoughts on how peers of yours in the institutional business will be positioning, and how much left of a catalyst there is from that perspective?
And you make an interesting point, Ollie. And for all of this incredible rally that we've seen, institutions continue to be cautious in terms of quite skeptical of this rally. In addition, money market flows or funds are at $4.6 trillion, a record. So there's a lot of money parked on the sideline. And what's really interesting is when we look at the exchange-traded fund flows, yes, there's been $13 billion in inflows into equities since the market lows, but there's been close to $70 billion in bonds. So it's not really the equity markets where we're seeing this euphoria. It's kind of more of the bond market as the Fed's come in and said, hey, we're going to buy a lot of junk bonds and corporate bonds and munis and things like that. Folks have been gobbling up fixed income assets. So it will be interesting to see if institutions gain conviction about the recovery and they come off the sidelines. It could be another catalyst for further strength in the market.
Yeah. Michael, I think it's an important reminder here as we see this morning yields jumping a little bit, but still so low. I don't think we need to have the conversation yet about the risk of yields, or do we? I mean, there's got to be a huge blowout in treasuries for that to be a problem, right?
Absolutely. We're at incredibly low levels from this standpoint. And I don't think, and the Fed has already used forward guidance just last week to tell us, don't worry about it, we're not going to raise rates until at least 2022. So I think that kind of low rates are here to stay as an important support mechanism for markets. And I think for all those that get concerned overall about valuations, if we're simply discounting, the future cash flows at some discount rate, right? That discount rate's a lot lower than normal, and inflation is a lot lower than normal, meaning investors can withstand slightly higher than normal valuations, which is what we currently have from that standpoint.